Ladies and gentlemen, good day and welcome to the Popular Vehicles and Services Limited Q1 FY26 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance of the company, and it may involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone telephone. Please note this conference is being recorded. I will now hand the conference over to Mr. Naveen Philip, Promoter and Managing Director from Popular Vehicles and Services Limited, for opening remarks. Thank you, and over to you, sir.
Thank you. Good morning, everyone, and a very warm welcome to our Q1 FY26 earnings call. Joining me today are Mr. Raj Narayan, our CEO of PVSL, and Abraham Maman, Group CFO, and other senior team members. The last 12 to 15 months have been challenging for the auto industry and particularly the small car scenario. Several external factors weighed on consumer sentiment, and our own performance too was impacted by these headwinds. This prompted us to look at our internal levers. Through effective cost control measures, we managed to improve our operating margins and reduce losses compared to Q4 of FY25. As part of our broader strategy to build a more resilient business, we are continuously focusing on cost control initiatives, undertaking selective divestments, and channeling resources towards high growth opportunities. Our revenue improved by 2%, supported by strong performance of our EV and luxury portfolio. At the same time, we remain committed to our expansion journey. We are strengthening our presence in existing markets while also entering new geographies in partnership with our OEMs. To elaborate further, we have received an LOI to establish 8 state-of-the-art 3S facilities in Punjab for BharatBenz, making our entry into a new state as an exclusive BharatBenz dealer across the entire region. This will be our third state for BharatBenz operations. This represents significant step in strengthening our footprint in North India, building our strong presence in Maharashtra and Tamil Nadu with BharatBenz. The facilities are strategically located across 8 locations, housing 3S facilities with a total of 32 service bays. The facilities represent a cumulative investment of approximately 12 crores. For Aether, we have received an LOI for Chennai. In fact, 2 LOIs for Chennai. The operations will be spread across 2 locations. The service center will initially feature 5 bays with the capacity to service approximately 450 vehicles per month. Total investment for setting up these facilities is approximately 75 lakhs, and we expect to commence operations by the first week of September. Maharashtra, we would be opening up the earlier LOI that we had for Maharashtra for Aether. We would be opening up 2 outlets by the end of this month. We've also received LOIs for Bangalore, marking an entry into Karnataka, our 4th state with Aether in this growing network. The facilities will be spread across 2 locations, one dedicated to an experience center, the other accommodating the experience center, service center, and warehouse. The service center will feature 5 bays with the capacity to service approximately 500 vehicles per month. The total investment for setting up these facilities is estimated around 1.2 crores. We expect operations to commence from second week of September. For Maruti, we continue to expand our operations in Bangalore. Operations are expected to commence by the end of August this year in terms of our true value, extended service, etc. All these initiatives are in line with our strategy to diversify and reduce our revenue contribution from Kerala to below 50%. Coming to the business overview, FY26 began with several uncertainties for the domestic passenger vehicle segment, with demand momentum remaining weak in Q1. Is typically a seasonally soft quarter for us. Both volumes and revenues declined, while we saw marginal uptick in April. May and June remained subdued. Our PV business, excluding luxury, was also impacted by the prolonged slowdown with entry and small car segment under pressure. However, our luxury cars delivered robust growth. In CV, India saw a robust YOY growth driven by the early month deliveries though muted infrastructure activity was there. For us, EV volumes improved sequentially but remained lower than the corresponding period of last year. The EV two-wheeler segment recorded strong YOY growth in Q1 FY26, reflecting rising consumer adoption and structural shift towards electrification. Our two-wheeler EV business also saw strong momentum with both volumes and revenue doubling year-on-year. Sequential growth was modest, in line with the seasonal nature of Q1. Aether's product continues to gain strong market acceptance, and as indicated earlier, we are successfully expanding our network in alignment with their growth plans. In new vehicle business, sales volume growth remains subdued due to weaker demand in the mass market segment. However, our ASP is improved, driven by a higher sales mix of premium and luxury vehicles, as well as better realization in CVs. The luxury portfolio posted healthy YoY growth in both volumes and realizations. However, sequentially, it declined as Q1 is seasonally weaker than Q4 in terms of volume figure. In pre-owned vehicles segment, we saw a positive development as volumes and realizations have increased. We saw more synergies between the new vehicle and pre-owned car sales. In our service business, though volumes remained flat due to element of seasonality, we were able to capture a higher wallet share and improve our ASP, especially in the CE and luxury vehicles. We remain optimistic about service volumes picking up going forward. As part of the festive season preparedness, there was a little ramp-up of inventory, but in terms of overall inventory, which currently stands at 43 or 44 days, and we expect this to taper down to about 37 days by end of September. We have implemented a discount control measures which significantly reduced discount levels from the FY25 peak. Our employee costs, the savings achieved through cost control measures have been strategically deployed towards expansion, annual increments, and strengthening the frontline sales team for the next phase of growth. In essence, the functions as an internal accrual with these additional expenses being offset by the efficiencies generated through cost discipline, which would otherwise have added to cost and further pressured margins. Consequently, the net impact of these savings is not immediately visible. That being said, we are consciously channeling resources towards their most effective use. To summarize, while Q1 is typically a seasonally slower quarter, we are encouraged by the early trends across segments. Luxury demand continues to grow, reflecting positive consumer sentiment in the premium categories. Pre-festive footfalls have also been encouraging, giving us confidence ahead of the festive season. Despite the tough environment, with the Indian economy expected to grow at a healthy pace and consumption likely to improve, we are continuing to execute our growth strategies, anticipating a demand recovery as we believe this is merely a prolonged slowdown and a long-term India growth story remains intact. We believe that as industry growth picks up, investments made and internal measures implemented over the last 12 to 15 months will enable us to deliver stronger performance going forward. With this, I would like to hand over the call to Abraham Mohammed, our Group CFO, to update you on the financial performance for the quarter gone. Thank you.
Thank you, Naveen, and good morning, everyone. I will take you all through the company's operational and financial performance for Q1 FY26. In the new vehicle business, the company sold 9,532 new vehicles versus 9,676 in similar quarter previous year, showing a 1.5% year-on-year growth. The total income from new vehicles sold was 932 crores, up 0.1% year-on-year from rupees 931 crores in Q1 of FY25. The average selling price increased by 1.6% from approximately 9,62,000 to 9,77,000. In new vehicle sales volume, passenger vehicle constituted 60%, commercial vehicles 26%, and EV 14%. Moving on to the pre-owned business, the company sold approximately 2,575 vehicles versus 2,472 in a similar quarter previous year, showing a 4.2% year-on-year growth. The total income from pre-owned vehicles sold was 93 crores, up 10.2% from rupees 85 crores in Q1 of FY25. The average selling price increased by 5.7% from approximately 3,42,000 to 3,62,000. In pre-owned car sales volume, passenger vehicles constituted 99% of the sales volume. In services, company services and repairs business did a volume of 2,53,851 vehicles vis-a-vis 2,54,358 in Q1 of FY25, showing a 0.2% year-on-year degrowth. The total income from vehicle services and repairs in business stood at 227 crores, up 4.5% from 217 crores in Q1 of FY25. The average selling price increased by 4.7% from 8,534 to 8,938. In services volume, passenger vehicle constitute 79%, commercial vehicles 18%, and EV 3%. The company's spare parts distribution business clocked a total income of 64 crores, up 1.8% year-on-year. Moving to the financial performance, our total income for the quarter stood at 1,316 crores, vis-a-vis 1,298 crores in quarter one of FY25, showing 1.3% year-on-year growth. EBITDA was 38.3 crores versus 52 crores in quarter one of FY25, a decrease of 26.3% year-on-year. EBITDA margin stands at 2.9% for quarter one of FY26. There was a loss of 8.8 crores versus PAT of rupees 5.4 crores in quarter one of FY25. Despite weaker volumes and revenue, we were able to lower the losses from quarter four of FY25. In the segmental performance, passenger vehicle revenue stood at 724 crores versus 734 crores in quarter one FY25, a decrease of 1.3%. Commercial vehicle revenue was 497.3 crores versus 479.9 crores in quarter one of FY25, an increase of 3.6%. In EV, revenue was 26.8 crores versus 13.6 crores in quarter one FY25, an increase of 97.7%. Other updates. Credit rating. CRISIL Ratings Limited have reaffirmed the rating awarded to the company as the long-term rating at CRISIL A stable and the short-term rating at CRISIL A1 on the outstanding rupees 468 crore bank loan facilities of the company. Popular Mega Motors India Limited, CRISIL Ratings have reaffirmed the rating awarded to the company as the long-term rating at CRISIL A stable and the short-term rating at CRISIL A1 on the outstanding of 235 crore bank loan facilities. Awards and recognitions. Popular Auto Works Private Limited company's wholly owned subsidiary received All India's first runner-up award for retail of the year 24-25 by JLR. Ranked number one in new bookings and new bookings growth across the JLR network in India. Popular Vehicles and Services Limited received the award for dealer with the highest paid service to sales ratio for Nexa by Maruti Suzuki. Popular Mega Motors India Private Limited company's wholly owned subsidiary received multiple accolades from Tata Motors. Best Customer Success Center for South India for months of May and June. Spare parts highest volume growth, FY25 in South India. In the business vertical revenue breakup for quarter one FY26, passenger vehicles including luxury is 55%, commercial vehicle contributes 38%, EV 2%, and the spare parts distribution 5%. State-wise revenue breakup for quarter one of FY26, Kerala stands at 58%, Tamil Nadu 26%, Karnataka 11%, and Maharashtra at 5%. That's it from my side. Now I would like to open the floor to questions and answers.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, please press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from Preet with Incred AMC. Please go ahead.
Thank you for the opportunity, sir. My first question will be on the line of discount. How much was the discount in absolute terms for this quarter, and how much higher was it from previous levels, like when previous 1 or 2 years back levels? Yeah.
Okay. On the Maruti side of the business, we've been able to bring down the discounts by almost 50% compared to Q4 of last year. On the Arena business, the average discount for the 3 months of the Q4 was averaging around 12,000, which we were able to bring down to about 5,500 to 6,000 range. Nexa was running around approximately 15,000 rupees per car. We've been able to bring that down to between 7,500 to 8,000 per car. Q1 over Q4. And Q4 over the past, say, a longer period, maybe 1 or 2 years, has been pretty high, because last year the discounts have been increasing every quarter throughout the entire year. So we've been able to bring it down in Q1 of this year.
Will it be more better in coming quarters, or this is the usual discount which you have to give?
So this quarter, it is Onam season, where, Maruti is also running a lot of offers from their side, whereby the dealers need not necessarily put in a lot of discounts. So mostly we should be able to hold it around there, maybe plus or minus 500 rupees per car.
Okay. Got it, sir. So my next question would be on the line of debt. What are your outlooks on debt? Are you planning for any debt reduction? And by when we can see reduction in debt, if any?
Okay. So when we look at the debt position, from the last year, our debt position has actually gone up because the previous year we had the benefits in terms of the IPO funding. With the expansion plans that which Naveen had mentioned, at this point, our debt's a little on the higher side, but we are expecting this to come down by quarter three of this year.
And if you can quantify by how much?
We're currently at around 540 crores in terms of the debt that we're looking at. We are trying to bring this down by at least 5 to 6% in terms of the numbers.
Okay. Got it, sir. And next question on the line of margin. How much more margin expansion we can see in coming quarters, and what would be the driver for this margin expansion? And when, as per your internal targets, when we will be back positive for the quarter?
Back to the normal.
Q2, I'm saying with the announcement of the GST and all that, we're just going to evaluate how that would play out for the entire festival season for us in Kerala. The remaining areas would be subdued itself. So Q2, unless we get clarity on that, it will be tough to estimate in terms of how the margins would play out in Q2. But Q3 and Q4, we expect a very high growth with the GST norms coming into play. And hence the effect on margins also coming.
New locations.
The expansion into some of the new locations might have it subdued, but we will still be better off from the Q2 and Q1 EBITDA margins.
Sorry, but I was not able to hear you properly. What I can interpret is you told that we will be better off from Q1 in coming quarters. Am I right?
In Q3 and Q4. Q2, we are not estimating it because of the GST announcements that have been made, and hence we don't know what the effect will be. So we'll have to wait and watch how that would play out over the next 10 to 15 days.
Okay, got it. And on inventory days, if you can mention how much was the inventory day as of June? Or maybe current?
As of June, we were able to bring down the overall inventories by about approximately 500 numbers, which translates to about 3.5 days. So as we speak, the overall inventory is in the range of about 45, 46 days.
So is it usual business level sales, right?
Yeah. With the festive season coming, it just started yesterday, so we expect increase in the purchase of the customer. Plus, generally, with the festive season starting off in the rest of the country from October onwards, the dispatches to Kerala and all will be much lower. So hopefully we should be able to bring down the inventory to under 30. Naveen mentioned 37 days earlier in the speech, so about 37 to 38 days by September 30th.
Okay. Thank you, sir. I'll join back in the queue.
Thank you. Ladies and gentlemen, if you wish to ask a question, you may press star and 1. The next question comes from Amit Agicha with HG Hawa & Co. Please go ahead.
Yeah, good morning, sir. Am I audible?
Yes, sir.
Yes.
Please go ahead.
Yeah. Thank you for the opportunity. Sir, this is in continuation to the previous participant's question, about debt. What is the blended cost of debt, current average rate of interest or borrowings?
See, current blended average in terms of the debt that we are is close to around 8.2% is the blended average that we're looking at. And that is primarily because of the higher interest rates that we have in the subsidiaries that we have. But this is expected to come down to below 8% in this quarter because of the lower rates that RBI has come back with.
Okay, can you, sir, speak something about the competition intensity also, like all the 4 states where you are belonging in, Kerala, Tamil Nadu, Karnataka, Maharashtra?
Sorry, didn't get your question. Could you please repeat?
The competition intensity.
Oh.
So, if you look at our expansion, hello?
Yes, sir.
So if you look at each of these specifically, so Aether does not have dealers within the Maharashtra areas that we have expanded to. One or two dealers per se in that Nagpur to Aurangabad area. In terms of Jaguar Land Rover, where we would be opening up by November or so, we would be the sole dealer in that area, that 14 district that we comprising that's centered out of Nagpur. Bharat Benz in Punjab, we are the sole dealer. So intensity across brands would be very different. Maruti in Karnataka, in Arena, we would be having about 9 dealers in Arena. But Bangalore market per se is, in terms of numbers, would be as large as the Kerala market,
Yeah.
which also has the same number of dealers, but many more outlets per se.
And sir, does the company plan to enter into new business verticals like leasing or digital platform or used car financing? Are these sectors being explored?
So we are constantly exploring where all we can expand in terms of not just within the dealerships, but outside of dealership in thing. As you had mentioned, in terms of used car or used CV financing. We're evaluating those options. We have not taken a decision yet.
And the last question is, like, can you share your 5-year vision?
So in terms of, as we had mentioned earlier, and when we went for the IPO also, we said that we would like to double ourselves every 3.5 to 4 years, so that we have a CAGR of at least approximately about 18 to 20%. So that going forward, we continue to keep that as the vision thing. So today we are at around 5,600 crores turnover. So within 4 years, we should be able to double of that, about 11,000 crores turnover. But then this keeping EBITDA margins, if our FY24 EBITDA margins were approximately 5%, having a delta increase on the EBITDA margins to closer to 6%.
Thank you, sir. That's it from my side, and all the best for the future. Thank you.
The next question comes from Shirish Pardesi with Motilal Oswal. Please go ahead.
Hey, hi, Naveen. Raj, thanks for the opportunity.
Yeah.
Am I audible?
Yeah.
So I think I have few questions. Starting from the GST, obviously we don't have a clarity at this time, but in your conversation with the OEM, what will happen? I mean, there are 3 things. One is the current inventory. Hopefully the GST rate will get revised downwards. So what will happen to the existing inventory then? And given this event is going to happen in the next 45-50 days, do you think the discounting will continue to at the elevated level?
Shirish, it's too early for us to say because even none of the OEMs have come back with clarity on any of these. But if you look at it in terms of schemes, for example, what Maruti has schemes for most of the smaller car segments is in the region of about 45 to 50,000 in terms of schemes for the festival season in Kerala. Okay. If you look at if there's a GST reduction of say from 28% to 18%, that's about 10% on an average ASP of about 5.5 in the arena sector, which is about 50,000, which would probably be lower in terms of flow through, so about 45,000. I would assume that the net savings to the consumer would be in the region of about 5 to 7,000, less of schemes, etc. But it's too early to say. In terms of inventory and how to go forward with it, I think most of the OEMs will wait for clarity from the government before deciding on how to tackle the inventory content.
Okay. My second question, if you go back when GST was implemented in 2017-18, initially we had a lot of... the question here is that if there is a clarity, do you think the customer will prepone or postpone its purchase because if discounting is not going to go up? So I'm just talking about consumer behavior. Is there any inquiry? Is there anything you can pick up from 2017 experience, how the consumer behavior changes? And second, given Kerala, do you think any particular segment of SUV or you can say that the hatchback will show a higher momentum because of the tax relief?
Yeah. So that's what I'm saying. If you look into H2 numbers, and that's the statement that I made earlier, in terms of if the GST is implemented and there's a drop in GST and et cetera, H2 numbers, given the fact that there's a 10% drop or whatever that percentage drop that will be there, the smaller cars should have a positive impact. This should be combined with the fact that the interest rates are also getting lowered, which is starting to have effect now. So I think combine that, I think H2 should be a very robust H2.
Okay.
In terms of consumer sentiment as of today, and since the Kerala festival season is on, the inquiries, the bookings, etc., are still on track right now.
Okay. No, I just wanted to confirm my thesis because Arena segment has been struggling last 2-3 years. So if this material change happens, do you think Arena will become again positive in second half and going forward?
That's our viewpoint also.
Okay. My second question is on the margins. You have been saying that there is a margin lever, but I think we are around 1.5 to 2.2, 2.9 segments. What are the margin levers you have going forward? Because if the volume picks up, obviously that is one tailwind you will have operating leverage. But beyond that, what are the costs which you think will be under control and we will see the margin expansion?
Sure. That's part of the news.
You can mention that. I'll just add to it.
So one is in terms of we have started in consultation with an outside entity. We did some surveys and we started something on increasing the revenue per car in service. And as of July end, we were compared to Q1, we were able to show traction in terms of per car revenue, and that traction is continuing in this month also. Plus, we have also done some cost restructuring on the employee side, which we mentioned in the earlier call also. Some of the other main levers, plus we intend to increase our body shop revenue also. So, anything to add on?
No, one is in terms of service margin expansion, and to add with, as we mentioned, that with the ASP of the cars going up and the Nexa Arena mix also shifting towards Nexa, that would have a margin impact also going forward.
Okay. Just last question. We have at this time 64 showrooms. If I look at next 3 to 4 quarters, what are the showrooms we have in pipeline and what is the number we are looking at the end of FY26 and maybe mid-27?
So across, as you said, in terms of expansion, BharatBenz, Tata Motors, Ather, Jaguar Land Rover, all of them we would be expanding in a similar manner what we have expanded in the last 3 years. Plus over and above that in terms of acquisitions. So to put an exact number would be tough, but the guidance that we have said that we would double our turnover in the within that 3-4 years, that continues to be. So accordingly, both the showroom and the service station count would increase.
Okay. Thank you, Naveen, and all the best.
Thanks, Srini.
Thank you. Ladies and gentlemen, if you wish to ask a question, you may press star and 1. The next question comes from Nilesh Doshi with AMC Asset Management. Please go ahead.
Hello. Good morning, Naveen sir. Am I audible?
Yeah.
Okay. Sir, we are the dealer of the vehicle for Maruti, JLR, BharatBenz, Tata Motor, etc. So particularly we are selling the product of the other OEM and the other dealers are also selling the product of the same OEM. So what differentiate Popular is doing to better than other dealers? And is there any area Popular succeed to gain the market share?
So we are strengthening our frontline manpower. I mean, I'll break it into two, three critical actions that we've initiated, right? In terms of, we've gone back to the basics in Q1 and started retraining the people in terms of the sales pitch. Second thing, our overall lead management system, we completely restructured it across May and June, and effective July it's functioning, where the inquiry being passed on to one executive. For example, a walk-in inquiry or a digital inquiry, which all comes this side, it is not created by that executive. To whom do we allocate? That was happening haphazardly by the immediate supervisor. So we have brought a scientific thing in terms of the past inquiry to retail conversion, how much is his self-generated inquiry base versus the inquiry that the company has given. We brought in a mix and we started that. So that is beginning to show some traction in terms of absolute numbers. We have also looked at our entire manpower placement in, down to the level of talukas and smaller towns to check what is the industry size there and, what is our manpower strength there. And we realize that in some of those smaller talukas, our manpower strength was also low, where the size of the business was high. So that we have done. I'm just giving you 2-3 examples. So we see Q1, there's a lot of effort has gone into some of these very micro granular detailing as well as corrections of basics, which would help us bring this up.
And it's more than that in terms of the differentiating factor across all the segments that we operate, be it passenger cars, luxury cars, EVs, commercial vehicles, is in terms of the service that we provide and the accessibility to service. And there we score above most dealers and we continue to strengthen that area per se, and which is a driving force for the sales also and increasing market share across all sectors.
And also a lot of automation to improve our efficiencies. Nilesh, when you called me about a month back, I was explaining about the automated test drive module, and you said you really liked it because you had an issue with when you wanted to buy a Grand Vitara, you didn't in Bombay or somewhere from some other area you faced that issue.
Yeah.
So all that actually bring in those efficiencies whereby the percentage of conversion from an inquiry will improve pretty strongly.
So the result of the action will be seen from the next or by the year end. Is it possible?
Yeah.
Okay. And sir, we have a main two business segment. One is the vehicle sale and other is the service business. The vehicle sales revenue is higher, but the EBITDA contribution is comparatively lower than the service business. But the large capex or opex are involved in the vehicle sale business, and it is contributing the less at the PBT level, particularly currently because there is an interest cost component also because of the higher inventory we have to maintain. So what is the position right now? Is there any feeling that it is changing and it will start at least 1/3 of the EBITDA of the total EBITDA from the vehicle sale? Is it possible?
So will it be contributing to 1/3 of the total sales? The investment that we do in sales and services, sales is much higher. Will it contribute to 1/3?
So, English, actually, in terms of service, the number of service stations that we open up are far higher than the number of showrooms that we open up, and even when we acquire other businesses. So actually, investments in service business is actually larger than the sales business per se.
But in vehicle sale, we have to maintain the certain inventory and which block our working capital, and so we require, there is a interest component is also there, but showroom is levies. We have to appoint some high paid salaried person. So I think the OPEX is higher in the showroom maintenance as well as require the large capex, but the contribution from the showroom is lesser in the EBITDA of the total overall EBITDA. So can we expect at least out of the total EBITDA, 1/3 comes from the showroom business?
So basically, Nilesh, the way we look at it is that if we don't have a sales center, then getting our services out of that particular location would actually be very difficult to do it, to get into a new market. So it has to be a mix of both. So when we look at it collectively to see whether the sales and the service center can together contribute to the total. If you look at isolation, Nilesh, it might be a little difficult, but yes, we are looking at those parameters to see how much of volume can we generate from that sales unit being there? What is my investment? What is my cost? What is my inventory that I put in? And how much more vehicles that I can add to make it actually more profitable and break even faster?
My side. We have exited from the Honda as well as the Piaggio and expanding for the Bharat.
Expanding
PV, because we have only the PV segment is the Maruti. Earlier there was a Honda, though the Honda was not performing at India level also, and so we rightly exited from the Honda. Is there any plan to add any other OEM, or we are satisfied with the Maruti and we are expanding the network of the Maruti? Is it like that, or we are focusing more in the CV segment and expanding the Bharat Benz business?
No. So we've given guidance that we would expand with all the current OEMs that we have. With Maruti, definitely we have expansion plans. And other than that, in the PV segment, we are also expanding with Jaguar Land Rover, which is why we are opening up Nagpur, and we are also in discussions with them to see if any other state is available for us to open out our operation.
Okay. That from my side.
We would also be looking at other luxury brands also.
Okay. Thank you, Navin sir. All the best for the future, sir.
Thank you.
Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. The next question comes from Preet with InCred AMC. Please go ahead.
Thank you for taking my follow-up question, sir. I would like to ask about the gross margin. Like you have mentioned that almost we are at par with the discount levels. Plus, we can see that in the current quarter or past 2-3 quarters, we have grown a good amount in service and sales business. Why are our gross margins less than the usual margins which we were having? Like we were used to have 14, 15, 16% the gross margin, and for the current quarter, it is just 13.4, 13.8 something.
Sorry, could you repeat the question, please?
I'm asking about the gross margin, like 15-16% blended gross margins, which has come down to 13.4, 13.5%, despite better product mix, like we have more contribution from service business this quarter, and also discount has come back to the previous levels. Then why our gross margins are less?
So actually the gross margins are around 14.7, 14.6%. Where we have had a major drop in gross margins is in terms of Piaggio, where it has gone down from 18% to over 14%. So there's a huge drop there. Whereas in terms of most of the big Maruti, the gross margins are still about 18.7% or so. PAW and PMML Tata is still around 9.8, Bharat Benz is around 12. The spares remains approximately around 12%. So it's only in Piaggio, and there's been some drop in terms of the JLR gross margins because of the product mix that we have. And that the fact that the higher in terms of overall share, ASPs in terms of JLR, the drop in prices and the gross margin. Yeah. So rest of it remains steady, and the overall gross margins at the group level, we are around 14.6, 14.7%.
And you will be continuing to have this same kind of margin, or will it grow?
No, it should go up further because we have also, there's a movement out of Piaggio. We should have some increase in margin there, and plus Q2, Q3, Q4 in terms of JLR margins, and the rest of it should be increasing. And if there's any positive coming out of the GST thing, that should add to it.
Okay.
With the mix going up.
Yeah. Next question on the line of sale of Honda and Piaggio business. What kind of amount we receive from sale of this, and will we be using it for another acquisition which we are planning? And also on the acquisition upfront, if you can tell what kind of acquisition are we targeting, and when can we expect the acquisition?
So our acquisition, what we had predicted is slowed. In terms of there has been a delay in the acquisition for Prime, but hopefully that should end with, be done with Q2. In terms of Honda and Piaggio exit, we are expecting approximately 70 crores to flow into the company. And yes, that would be used not just for acquisition, for any expansion.
And it will be all the 70 crores will be used for expansion and not for the debt reduction. Am I right?
It could be a combination of whatever it is. So at that point of time, we will look at it. So it could be a combination of a new acquisition, expansion, or the debt reduction that we really do.
And when can we expect this sale to offer and money to receive?
We should
By
expect
the end of this month.
By end of this month.
Yeah.
yes.
Okay. And on acquisition upfront, you mentioned something which I missed. Can you repeat? What kind of acquisition are we planning and when can we expect?
We're hoping that by Q2 we should be able to close out 1 or 2 acquisitions per se. We are looking at in the stage of Telangana as of now.
Okay. Thank you, sir. I'll join back in the queue.
Thank you. Participants, to ask a question, you may press star and 1. The next question comes from Ashish Roth with Deep Sea Securities. Please go ahead.
Hello, am I audible? Hello.
Oh, yes.
Yes.
Yeah. So I have a couple of questions. So the first question on how has our Kerala markets has performed in terms of the new vehicle growth from Q4 FY25 to Q1 FY26, and have you seen any erosion in the market share there?
So this you're asking about the overall Kerala industry, right?
Yes.
All OEMs put together, right?
No. So in terms of our market share.
Okay. Our market share, sequentially quarter-on-quarter, we've been more or less on par. We have now neither gained nor lost in Kerala.
In PVF.
In Maruti side of the business. In Chennai, we've been able to grow by about 0.4-0.5%. We've been able to grow in this quarter.
Across the businesses, both in terms of, in Kerala, if you look at the other businesses, both Tata Motors and Ather, we've been able to grow our market share in the areas that we operate.
Even JLR has gone up.
No, you specifically asked about Kerala market.
Okay.
And yeah, in Karnataka, our JLR market share has also gone up by about 2-3 percentage points.
Okay. And one more bookkeeping question. What is the impairment loss? And it has increased by around 3 crores.
Okay. So this is more in terms of a provision that we've actually created in the books, and we are in the process of actually collecting those outstanding. So we may probably get a benefit of this in the next quarter that we have. The collection process in terms of debtors, we've started a rigorous process of collection. So we're hoping that this impairment that we created in this books for the quarter 1, we will get a reversal. The benefit should come through in quarter 2.
Okay. Thank you, sir. That's it from my side.
Thank you. A reminder to all participants that you may press star and 1 to ask a question. The next question comes from the line of Preet with Incred AMC. Please go ahead.
Thank you for taking my question back. Sir, you have mentioned about your vision for like 4-5 years, like that you have to grow revenue by 3.5x and making EBITDA margin to be around 6%. If you can give some guidance on short-term X of acquisition which we are planning, like what kind of top line are we expecting and margin are we expecting in FY26 and FY27?
FY26, I'm saying, keeping the acquisitions and the expansion aside, we would probably, with the H2 being stronger, we would be closer to the FY25 group margins about 4.5% in terms of EBITDA. And if you look at FY27, we are expecting our EBITDA margins to go back to about 5% in terms of EBITDA margins.
Sir, what did you mention about FY26? Can you repeat?
FY 26, I'm keeping the new acquisitions because we don't know when that will happen. But if you leave aside the new acquisitions, the EBITDA margins would be closer to FY 25, which would be about 4.5%.
Okay. Thank you, sir.
Thank you. As there are no further questions from the participants, I now hand the conference over to Mr. Naveen Philip for closing comments.
Thank you all for participating in our earnings call today. We're taking decisive steps to remain steadfast in our commitment to achieving our growth ambitions with our long-term vision firmly on track. We trust that we have addressed all your queries. Should you have any further questions, please reach out to Strategic Growth Advisors, our investor relation advisors. Thank you.
Thank you. On behalf of Popular Vehicles and Services Limited, that concludes this conference.